the file after finishing the class. Okay. Should I begin? So in previous session, we finished our discussion by understanding how portfolio management or portfolio management team or portfolio managers oversee the whole process of portfolio management, which starts with understanding the desire of your client and developing the IPS based on that understanding, and execute the plan by allocating assets based on the preference of and based on the preference and the risk profile of the client, and make some analysis to decide which securities are to be included in a particular asset class. And then after making portfolio construction by analyzing the risk return, uh, this profile of the securities, after a certain period of time, you want to check the performance and you want to report as a portfolio manager how you performed, and you report your performance to the clients so that clients get satisfied and decide to whether they will keep up their money with you or withdraw money from your management. And portfolio monitoring and rebalancing is a continuous process which you need to be aware of to make sure that you are complying with the IPS of the client constantly, and you are understanding the changes in market condition and the volatility, these things. And we try to show you the differences between endowment fund portfolio and insurance company portfolio. And one point we tried to highlight that uh, endowment portfolio has the higher allocation. Uh, Indeed, it is a kind of highest allocation. This university has made allocation of around 25.1% to hedge fund, and this university has made highest 26.7% allocation in public equity. So we'll try to know about this later of this session. And in contrast, the insurance company, what is the focus that they allocated 56% of their portfolio in fixed income, particularly bond, because insurance company is committed to meet the claim of the policyholders. So it is not very likely that they will be able to engage or they'll be able to devote their significant portfolio to high risk investment, because they are committed to pay the claim of the policyholders. However, endowment fund, which is usually set up to meet the regular expenses of uh, institutions like university, then educational institution like this. So they are not committed to such kind of commitments which are with insurance companies. So you can see the difference that they are taking higher risk by investing in hedge fund, and this university also taking higher risk by investing a good percentage in public equity. So,
Sir,
yeah.
Sir, is the endowment fund is perpetual?
Endowment fund.
Yes, sir. Is it perpetual?
It depends on the institution. It depends on the institution of which the endowment fund is running. Okay. If the institution of which endowment fund is running, if the institution is such that the institution is perpetual nature, the endowment fund will go on.
Sir,
Yeah.
স্যার হেজ ফান্ডের আরেক নাম ওখানে অ্যাবসোলুট কি যেন একটা ছিল ওটার কারণ কি স্যার?
This is the absolute return. This is a particular strategy of hedge fund. So based on hedge fund, there are hedge fund has different focuses when they make investment. So one particular focus, maybe they will try to take huge amount of leverage, or they will try to focus more on derivative instrument. So this hedge fund in particular is focused on achieving absolute return. And you probably have learned about the absolute return and the relative return in terms of capital gain and current income from your investment analysis course. Okay. So let's think from the perspective of investor in the asset management industry. If you want to find some asset manager or portfolio manager as an investor, what kind of investors or what kind of clients the portfolio managers face in the asset management industry? First of all, very simplistically, the investors can be the individual investor. Let's think of a person, salaried person who has a decent salary, or who is doing job in private sector or public sector, assuming that that person has pension plan from his employer. From his employer, this person received pension plan. So out of the available pension plan, we separate pension plan in two types. One is defined contribution, another one is defined benefit pension plan. So you need to understand what is the basic difference. However, you will understand how this pension plan works in detail in your advanced course in portfolio management. Okay. So what's the core difference between these two? In defined contribution plan, employer is committed to give you or contribute a specific amount, a specific dollar amount, or a specific taka amount in your plan on monthly basis or a periodic basis, usually monthly basis. The employer is not committed to something like that after your retirement, I will pay you 1 crore taka for doing job in my company. It's not like that. In case of defined contribution plan, because employer has committed to make a monthly dollar contribution or monthly taka contribution to your plan. So you also participate in this plan by allocating some amount of money from your monthly salary to this plan, and this amount in the plan is invested by portfolio manager. So if when this plan is invested in different securities like equity, bond, or hedge fund like this, okay, there is a risk that this portfolio will go up and down. Who will bear this risk? The individual person, specifically employee, will bear the risk. Employer does not take care of that, because employer is committed to give you only a specific amount of money monthly, and the risk profile or the volatility of the portfolio, the risk of the investment is to be borne by whom? By the
employee.
employee. And in contrast, in case of defined benefit pension plan, employer is committed to give you a lump sum amount of money after your retirement. And simplistically, I have taken 1 crore, but there is a calculation that how this lump sum amount will be calculated. It is based on some certain factors. You probably have heard about how the pension benefit in our country is estimated. Okay, so some factors like this. What is the basic salary? What is the basic salary on the date in which you are taking your retirement? This is one factor. Another factor is tenure, the number of years for which you worked with me. Okay, so these are the some certain factors which will be considered to estimate what amount of benefit you are entitled to receive from the employer. And over the time, you probably have heard about the and learned very well indeed the time value of money, that when you have committed a lump sum amount of money to give it to someone, let's say this amount is 1 crore. Every month or every period, as an employer, what you need to do? You need to make some contribution here.
Yes, sir.
And after a certain amount of return in each period, you will have this amount what you plan to have after a certain, for example, after 30 years. So there will be again ups and downs of this portfolio. In this case, who will bear the risk?
So the employer bears the risk.
Employer will bear the risk.
Employer will bear the risk. Employee does not bother about it. So this is the typical example of our defined benefit pension plan, is a kind of example of our pension plan which is available in our country. Am I clear? The employee or the employees in our country who have the pension benefit or pension defined benefit pension plan from their employer does not bother whether my employer is facing loss or facing risk in the portfolio they are managing for their employees. Employee is very certain that after his retirement or after her retirement, they will get a certain amount of benefit. Have you got the difference between these two?
Yes, sir.
Yes, sir.
Okay, so you need to understand each of these. First of all, we are talking about the individual investor. You are a portfolio manager. You are thinking, you are understanding the clients which will be which you will face when you will engage in portfolio management in asset management industry. Okay. So first of all, if it is like that, as an individual investor, eh, you have a contribution pension plan, and it can be, for example, 10,000 employees. So if it is like that, out of 10,000 employees, around 9,000 employees is going for retirement, it is not the scenario. I'm just taking an extreme case. If it is like that, 9,000 employees out of 10,000 employees who are under this plan is going for retirement. In that case, the horizon available to you as a portfolio manager for this plan is narrow or wide?
Sir, because of the internet disruption, sir.
From my end, it is
স্যার কোশ্চেন
okay.
শোনা যায় না আপনি যেটা
Okay.
যেটা বলছিলেন
Okay.
Yes, sir.
Okay. We are thinking of this contribution pension plan from individual perspective. Okay. A particular individual, for example, has retirement age 65, and it is only 5 years he is staying from retirement. He's staying 5 years before his retirement. And another employee, for example, like you, his age is his employment. In his employment, his current age is 23 years. So if his retirement age is 65, in which employee case, for example, this is employee B and this is employee A, in which case time horizon is longer?
স্যার আপনার ভয়েসটা অনেক ইন্টারাপ্টেড হচ্ছে, কথা
Sir.
প্রায় বোঝাই যাচ্ছে না।
আপনার কথা শোনা যাচ্ছে
Sir,
না
কেটে
স্যার।
যাচ্ছে।
শোনা যাচ্ছে না, বাট
Sir,
আমার
কেটে
এর থেকে
কেটে
দেখতে
যাচ্ছে
পাচ্ছি
মাঝে
আমার
মাঝে।
সাউন্ডটা আমার নেটওয়ার্কে স্ট্রেংথ আছে। আমি ল্যান্ড কানেকশন ইউজ করছি। এখন কি শোনা যাচ্ছে? হ্যালো,
স্যার মাঝে মাঝে শোনা যাচ্ছে না।
মাঝে মাঝে
কথা
শোনা
চলে
যাচ্ছে।
যাচ্ছে, আবার কথা আসতেছে।
মাঝে এক দুইটা ওয়ার্ড কেটে যায়, বাকি সব ঠিক আছে।
আচ্ছা, let's try to take the alternative. Is it now clear?
Yes, sir.
Yes, sir. Clear, sir.
Okay, fine. So what we are talking about, think of two employees. One employee is A, another employee is B. Between these two employees, one employee, particular A, is 5 years. He has 5 years for his retirement to reach his retirement age 65. And this person who is currently 23 years old, his retirement age is also 65. But what do you think between person A and person B? This person has longer time to reach the retirement.
Yes, sir.
So between A and B, which investor the time horizon is higher. For investor B, the time horizon is higher. In that case, can investor A go for taking higher position for longer term investment in his portfolio?
No, sir.
No, sir.
So he needs to focus, or portfolio manager on behalf of this client A needs to focus more on shorter or intermediate term investment. Okay.
Yes, sir.
And in terms of risk tolerance, the person who is only 5 years to reach his retirement, do you think that person is a very aged person?
Yes, sir. So he
And
should
the
be.
yeah, and the person who is
Yes, sir.
yeah, and the person who is only 23 years old, that person is more younger compared to
Yes,
this
sir.
person. So between this person, assuming all other things remaining same, which person has higher risk tolerance?
So the younger person.
The younger person has higher risk tolerance. Okay. And the person who is young, he has a good job right now currently going on, and the aged person, his job is also going on. But between these two person, aged and the young person, who has higher flow of income from his job right now?
So the aged person.
Aged person, because he is right now in a senior position, and the young person is in a junior position. In that case, the aged person has less desire to receive income from his portfolio. However, young person has less amount of income from his job. That's why he will need more income from his portfolio, right?
Yes, sir.
Okay. And in terms of liquidity need, the aged person and the young person, how you can decide?
Sir,
What about the liquidity need?
The aged person would need more liquidity, more cash, because he is going into retirement. He must be willing to buy
He is
expensive
going to
house.
retirement. That is a future event. But right now, what can happen? It depends on their planned expenditure. If it is like that, they are going to meet a good plan. They are wanting to meet big expenditure. In that case, who is able to support from his own income? More
So the aged person.
the aged person. So in that case, liquidity need may vary from person to person. So what is the summary? That in case of defined contribution pension plan, all of this consideration will vary from person to person. We just have taken a simple example between by considering two person. One is aged, another one is younger person. Okay. In case of defined benefit pension plan, it depends on the retirement age of all the employees who are covered in this plan. It is company sponsored plan, employer company sponsored plan. It is, if it is like that, in extreme case, that company has a higher, for example, 70% of the employee of this company are younger. In that case, this pension plan has a higher time horizon. Is it?
Yes, sir.
Okay. So endowment and foundation. Endowment and foundation, let's try to understand. We just have given a highlight that endowment is usually used by the, it is a kind of a fund where the contribution can come from the alumni, contribution can come from the donors, contribution can come from the sponsors. And this portfolio or this fund is managed and invested. And from these current expenses of the university, the current expenses of the university are maintained. So usually this endowment has a longer term horizon, and related to that, if it as it has a longer time horizon, it can take more risk. It can take more risk, and that's why in previous slide you saw that the university endowment fund was allocating their investment in hedge fund as a big portion, and also in public equity, and you will also find that they are investing in private equity like this. Okay. However, in case of foundation, almost their characteristics are similar, but foundation is mostly for charitable or the institution which is solely dependent on the charity made by the sponsor or made by the donors. Okay, you probably have heard about the Bill and Melinda Gates Foundation. You probably have heard about the Bill and Melinda Gates Foundation?
Yes, sir.
Yes, sir.
And you also have heard about some foundations who are sponsoring the gold medal in our faculty.
Yes, sir.
So how these foundations are formed? These foundations are formed by a lump sum amount or a periodic contribution from the sponsors. And this foundation is managed, fund of this foundation is managed in such a way so that the beneficiary of the foundations get a flow from this foundation regularly. So usually this foundation has also higher time horizon and higher risk tolerance like the endowment fund. And usually they are not, they don't face short-term liquidity need. However, their income need can be greater in case of foundation, because the institution which is solely dependent on the foundation, the institution mostly charitable institution, that institution does not generate income by themselves. They depend on the income coming from the portfolio of the foundation. Okay. And insurance company, it can be another investor, and they have a good participation as an investor, because you know very well they collect a good amount of premium from their policyholders, and policyholders' money is maintained in a separate account, and they maintain another separate account to take the money separately, which will be invested or which will be invested in other income generating asset. So they are regulated by the regulatory companies. However, between life and property and casualty insurance, okay, what do you think between these two, which one has higher risk tolerance? What is your
Life
The
insurance.
life insurance.
life insurance has a higher risk tolerance because
Because of the time horizon.
okay, then why property and casualty insurance does not have or has less risk tolerance? Their time horizon is usually shorter. It is not like that you have taken a car insurance and this policy will cover your car accident for 30 years. Is it like this?
No, sir.
You need to upgrade this policy time to time. Okay. And in investment companies, you probably have heard about our investment companies who are usually engaged in underwriting and taking companies to the public market by working as an issue manager. So these companies also have portfolio. So if you think of their time horizon, risk tolerance, income needs, you need to analyze that. And if you want to understand the sovereign wealth fund, that is the fund maintained by the government to meet up some certain long-term lump sum expenditure in a future period of time. For example, Bangladesh has planned to construct a fund which will be, for example, 10 years. And after 10 years from this fund, government will set up or government will establish a solar plant. Okay. So that can be one example of sovereign wealth fund. It is sponsored by the government. And in case of bank, if I ask you, what will be the risk tolerance of the bank? How it will be? It will be very high. They can tolerate very high volatility in their portfolio.
No, sir. So because banks use other people's money. Banks needs other people's money, and bank has a contract with them that they will have to repay that that the bank collects. That the bank can use for a certain amount of time. But sir, other reserves that the bank has, they have to repay
Okay.
that just for a long time with high risk exposure.
Okay, got it. Okay. So these investors are institutional investors, what you can understand easily as a portfolio manager. And the investors who are using this plan or who are purchasing this plan or who are subscribing this plan, they are the individual investor. So you need to understand your investors very well. And one point that I like to highlight, that is, if I ask you that you are an employer, between defined contribution pension plan and the defined benefit pension plan, which one you will prefer?
Defined contributor pension plans.
As an employer, you will prefer defined contribution pension plan, and the countries like US are trying to, a country means the employers in USA are trying to shift their focus more on the defined contribution pension plan. It is shortly known as DC plan. And the countries which are more socialist countries like UK and European countries, if you analyze their share of DC or DV, you will see in these countries, the share of defined benefit pension plan is bigger compared to defined contribution pension plan. And the recent trend is that employer globally are trying to shift their focus more on the defined contribution plan because of the increasing volatility, increasing risk in the market. And sometimes employer or the specifically the sponsor of defined benefit pension plan feels it very risky to continue this kind of plan because they are committed to have to give a lump sum amount of money to their employees, and it is a longer time horizon. So they are trying to reduce their risk by shifting their focus to which plan? Defined contribution pension plan. Okay. And if you try to understand the asset management industry globally, you will see that it is highly concentrated in this region, North America and Europe, because their market size is 37.4 plus 22.2, more than close to 60%, close to 60% only in these two regions. And you can understand easily what about the Asia and what about the Middle East, and you can understand what is about the market size in Bangladesh. You should have a picture in your mind that what will be the potential market size if this is the global scenario. Okay. So we'll try to give you some number later of this discussion. So let's try to understand the asset management industry from the company perspective or the players perspective who are playing in the asset management industry, or who are the institutions who are offering the asset management services in the asset management industry. Okay. So first of all, there are some pure play independent asset managers. So who are pure play independent asset managers? For example, you probably have heard about, I showed you in last class, that Edge Bangladesh Asset Management Company. Then there is a company which is also known as Race. So you probably have heard about this company name. So this asset management company does not have any subsidiary, or they are not the subsidiary of any holding company. They are the independent asset management company. So their full focus or the business of these companies are to engage in asset management services, and they don't have any other services. Okay. In contrast, you probably have heard about ICB very well, the state-owned investment bank, and you will see several subsidiaries of ICB. So one of the subsidiaries of ICB is ICB Asset Management Company Limited. And if you see the subsidiary companies of IDLC, you'll see one company is IDLC Asset Management Company. In short, it is known as AMC. Okay. So what is the difference between these two and these two? These companies are subsidiary
When
of
asset manager self,
yeah, I'm listening.
sir, the independent asset managers are fully focused on only asset management, and they do not have any subsidiary, other subsidiary. They do not engage in other activities, and they do not have, they are not part of any other organization. They are not subsidiary. They do not have any other subsidiary. They're only focused on asset management company and not in any other business activity.
Okay. So these companies have diversified business portfolio. So, for example, IDLC has investment, IDLC has securities, IDLC has IDLC Finance is the holding company. So they have some other businesses other than the asset management services. Okay. So that is that's why the term pure play has been used here to identify the asset management firms who are solely engaged in asset management services. So in this industry, you will see two types of firm or two types of analysts. You may be more specific, who are either sell side or buy side. So typically, after having your graduation completed, you will try to apply for this kind of position, sell side position. So who are this person or who are these firms? They engage in selling investment product, and they also sell investment research to the clients. Would you please mute your mic so that noise will not come? I'm listening some noise. Okay, fine. So sales side firms or sales side managers, what they do, they sell investment products. They sell investment research to bring more clients to their firm. So for example, in asset management company who are engaged in sales side services, you will see that some managers are engaged in, they have been allocated to work or to make research or to have research works on some certain sectors. For example, one particular research analyst look at the bank and financial institution. Another particular research analyst focused on textile. So what they do, this analyst collect information and visit company to analyze some particular specific companies on in the textile sector, and prepare this research report and sell these reports to the clients so that client inject more fund to their portfolio manager. So typically, this role are common. However, in contrast to sell side firm, there are buy side firm. Yeah.
Sir, an example of investment product is mutual funds. Sir, is it right?
Yeah. So in contrast to sell side firm or sell side analyst, there are buy side firm or buy side analyst. You can simply think of mutual fund as a buy side firm, or the mutual fund manager as a buy side analyst. Okay. So what they do, they collect research from sell side companies. They make research by themselves, and they collect other available information, and they try to understand the market and what will be the good time to buy the stock, and what will be the time to not to buy the stock, or how long we will hold the stock. This decision will be taken by the buy side firm. Okay, but what is the difference? The difference is that, for example, sell side analyst, a particular sell side analyst has said that 250 is the target price of ACI. Okay, who has shared this research? The sell side analyst, a particular sell side analyst. However, what buy side analyst will do? Buy side analyst will not depend only on this price. Buy side analyst will collect several reports from several research analysts. For example, the average of this price is 245. So 245 is the target price to buy to whom? To the buy side analyst. But what was the recommendation of the target price of a particular sell side analyst? It was 250. So buy side analyst himself has made his own research and collect other supporting information, and ended up to decide to buy up SCI at 245. Okay. And between a specialist and full service, this is kind of, you can think of the dealer and broker, dealer versus broker. They have the differences, but what we will try to focus here, that is specialist will purely engage in asset management services with certain focus. For example, they particularly, they only have mutual fund. They don't have the hedge fund. They don't have especially mentioned, separately managed account. They don't have the other fund. They don't have the bond fund. They have particular focus on equity mutual fund. In that case, they are the specialist. However, if you think of a firm like Vanguard, they have an array of products starting from plain vanilla equity fund or plain vanilla bond mutual fund and hedge fund. So this asset management company has a full service. They provide an array of products to their clients. So we'll try to focus some trends of the asset management industry before trying to understand what is happening in Bangladesh in brief. Between active and passive management, you probably have heard about it in your investment analysis course. That you probably have heard about it, right? Index.
Yes, sir. Index was covered, sir.
Okay. So index, it is not only market specific. We have a tendency to understand that market has an index only. Okay. So other than the market, any institution can develop index. Any institution can develop index. It is not like that we are very familiar with BSE-X or S&P 500 like this, okay, or DS30 like this. However, you probably have heard about that Vanguard, an investment bank, then Barclays. These firms have developed an wide array of indexes to by having some policies for their specific indexes. So if it is like that, a particular asset management company, let's say asset management company A, this asset management company is following or replicating Vanguard Vanguard high yield corporate bond mutual fund. So what does it mean, replicating this index? It means that this firm's portfolio, or this asset management company, has constructed their portfolio in such a way that their portfolio consists only those securities which, only those bonds which are in this index developed by the Vanguard. They have not included other bond, and they are trying to maintain this, the weight of this particular index. Okay. So in that case, this asset management company fund is replicating or trying to replicate this index. In that case, they are not managing their fund actively. Rather, they are managing their fund passively. So in that case, if you are an asset manager, you are trying to do this. Will you make more research? Will you make more trading by yourself? What do you think? You are simply following this. You are trying to replicate this particular index. Will you engage in more research, more trading?
No, sir.
In that case, what will happen? Your cost will go down.
Yes, sir. Research cost will be eliminated.
In contrast, what will happen to the active management? Active management will make fundamental analysis, will make technical analysis, will make their own particular strategies they will try to follow. They will not replicate this kind of indexes blindly. In that case, what will happen? As an active manager,
their operating cost will increase.
your cost will go up. So, who has higher risk?
An active manager?
Passive manager.
Active asset manager is likely to have higher risk and also is likely to have higher capital gain. So if you are an investor who has very low risk return trade-off, I mean your risk tolerance is low and you don't want to have very high return, which one you will prefer? Passive or active?
It's a passive.
Passive.
You will prefer passive. And if the scenario is just the opposite, you will prefer active. Okay?
Sure, manager.
You will prefer active. Let's assume that you are a pharma investor. You are pharma investor. What I'm trying to mean by pharma investor, because you believe in the philosophy shared by the pharma. Okay. You are very familiar with the Eugene Pharma?
Yes, sir.
Okay. What pharma says that market is efficient. Market is efficient, right? Is it? Has pharma said like this? You learn which form of market efficiency, semi-strong form of market efficiency. You heard about it?
Yes, sir.
Okay. So, if you believe in pharma's word, you invest in active management firm or passive management fund?
It's a passive management firm.
Because there is less room available to find out an attractive stock which is undervalued. Because market is efficient, information is reflected in price. Is it like
The
this?
value will be equal to price.
Yeah. Okay. And what are the trending strategy? The trending strategy is that instead of actively analyzing a particular stock, analysts are relying more on the strategies which are mostly passive management strategy. One example is a smart beta. You probably have heard that pharma has found that the stocks or the companies of the small size outperforms relative to big size firm. Is it? A small size stock outperform the large size stock. You heard
Yes, sir.
about it?
Yes, sir.
And also about value. I'm not going there. So can it be like this, that you will buy the stock of which size, based on the size beta, there is a size factor. There's a size factor, like the market factor, size factor. So in that case, what you will try to do? If small size If a small size stocks outperform, if a small size stocks outperform, you will try to analyze the size beta, and you will try to buy the stock of which size is smaller and sell the stock of which size is bigger. In that case, what will happen? You will have a positive return. What
Yes,
you're
sir.
doing, buying low size stock and selling big sized stock. And if it is like that, the companies which are momentum stock, momentum, you probably have heard about it. The stocks which performed very well recently, they are the momentum stock.
Yes, sir.
So if it is like that, the momentum strategy will continue or momentum will outperform. What you will try to do? You will try to pick the stock, you will try to pick the stock of which momentum beta is higher. In that case, the size beta, value beta, the momentum beta, these are known as smart beta. Because instead of analyzing actively, you are trying to focus particular factor in a factor, and you are constructing your portfolio based on that particular factor and their beta, and you are trying to expect higher return by
Sir,
capitalizing those portfolio. Yeah,
sir, momentum বিটার থেকে একটু কেটে গিয়েছিল, আরেকবার একটু বলবেন?
বুঝি নাই।
স্যার, momentum better থেকে একটু কেটে গিয়েছিল কথাটা, আরেকবার একটু বলবেন?
Okay, the thing is that the momentum stocks are those stocks which perform very well recently. So if it is like that, momentum trend will continue. Which stocks you will prefer? You will prefer the stocks which has higher momentum beta.
Yes, sir.
That is the discussion. Okay. And next focus is traditional versus alternative asset manager. Traditional asset managers tries to shift their focus on traditional asset classes. You are very familiar with the traditional asset class, equity, bond, these funds, okay, or this asset class. However, alternative asset managers tries to shift focus on venture capital, private equity, hedge fund. In venture capital, you are shifting focus on a startup, and you are also focusing on derivative, okay, this alternative. So based on your focus, you may be considered as traditional asset manager or alternative asset manager. And when you are alternative asset manager, instead of having income only from a particular percentage of fee from asset under management, you are also trying to have a gain from the performance of, for example, private equity fund, from the performance of private equity fund, or from the performance of a startup firm. You are trying to take a share instead of in addition to having a flat percentage from the asset under management. You are trying to achieve income from the performance based on what? Based on your investment in private equity, based on your investment in a startup firm. So the fee which is dependent on the performance, you are trying to focus. For example, you are trying to say that 20% of the profit, 20% of the profit. Here in this case, for example, 2% of the asset under management. But here we are saying what? 20% of profit, not asset under management. Asset under management, it is the traditional asset managers have income like this. But here you are trying to achieve 20% of the profit of this, for example, startup firm or the venture capital fund. In that case, this kind of fee based on the performance of the firm is known as carried interest. Okay, so these are some high-level highlights of this trend. And another thing is that most of the asset management companies in the world are privately held or private limited companies. Okay. However, you will see that some asset management firms are publicly traded. So if I ask you that ICB Asset Management Company is publicly traded or privately held?
So privately held.
How?
Sir, I haven't seen
It's not ICB a publicly listed company?
in them.
Is ICB a publicly listed company?
Yes, sir. Most probably, yes, sir.
ICB is a publicly listed. Anyone else?
Yes, sir.
Okay. So in that case, this asset management company, which is subsidiary of this ICB, is also publicly traded. I mean, it is not independently publicly traded as their holding company is publicly traded. Can we think of that this asset management company is also publicly traded in the name of their holding company?
Yes, sir.
Okay. And we are trying to focus some fintech in the asset management industry. Before that, I already have mentioned some reason why investors are trying to focus more on passive investing because the market is getting more efficient because of availability of information, more real-time information. That's why it has been found that the trend or the growth of passive investing has become significant in recent years compared to the active investing. And in fintech part, what we try to mention that in asset management industry, you need to understand how big data and robo-advisory services are trending in this industry. So in big data, the data are unstructured data and the size is usually estimated in terms of petabyte. Have you heard about it? Petabyte?
Yes, sir.
Yes, sir.
Okay. So it is a huge size. For example, let me give you one example instead of telling you what big data is. Okay. For example, you are analyzing ACI logistics. Okay. So ACI Logistics is the company name of Shopno. So if satellite image is available for the number of cars which are visiting the Shopno outlet every day. Are you getting? In Shopno
Yes, sir.
outlet, when customers go there by their car. Okay, they park their car in parking. So if satellite image of this parking space of Shopno becomes available to the asset manager, okay, and if asset manager get an insight that this parking space is getting more crowded nowadays, more crowded, what is going to happen? What do you expect? That the
So
revenue
the revenue of shop
of ACI
will-
Logistics is going to rise
Yes, sir.
in coming days. So it is a kind of real-time data or close to real-time. Okay. So in that case, if you're a particular asset manager A and another particular asset manager B, if this asset manager has access to big data and this asset manager updates his target price estimate right after having this information from satellite image, and another asset manager B who depends on the financial statements which are released after a specific period of time, which is historical information, which is providing historical and not real time at all. Between A and B, which asset manager will outperform?
So A will outperform.
Have you got it? How can you use it? And
Yes, sir.
another example is social media data. For example, people are talking more about. Have you heard about this product named Zeppelin?
Yes, sir. Hand sanitizing, probably. Hand sanitizer.
Okay. So this is a new product of ACI. So if it is like that, you have information of the post or comments made by the social media user on this product, and you analyze the there's a technique which is known as text analysis. So when you have this unstructured data, a million of posts, million of comments where the Zeppelin word is mentioned, and you have analyzed the text and you have found that 80% of the posts and comments on Zeppelin are positive. In that case, will you be able to update the target price in a real time?
Yes, sir. The real target price will go up.
Yeah. So in that case, the opposite can also happen. Probably you have heard about that ACI has I mentioned in last class that ACI has faced some penalties from the regulatory authority to use the methanol instead of ethanol in their sanitizer product. So when you see that the people in social media are not very sensitive to this news, in that case, if you update the target price with a very low price, will it be right?
No, sir.
You need to understand what people are thinking. Rather than the actual information, you also need to understand what customers are actually thinking, how customers' perception has changed for this news. Okay. And robo advisory services, the asset management industry are now taking the service of robotic engineering in a way, like for example, there are some sites, some browser or some app which are solely based on artificial intelligence and machine learning. If you visit this app and give answer to some specific question which are usually asked by the asset manager physically to their client, or they collect the survey form from their client physically. If you answer this question to this app or to this site, you will get a hint or you will get a suggestion that invest, for example, invest invest 20% in popular stock, invest 60% in tech stock, invest 40% in treasury bond, invest 20% in treasury bond like this. So traditionally, this percentage should come from asset manager himself. But right now you are getting this percentage from whom? From this app or from this site, which has been thought based on the machine learning technology. Have you got it? So how this app has learned? For example, this app has been given information of 1 million investor. 1 million investor. And out of this 1 million investors, the pattern of the good investment of this 1 million investor has been taught to this app in the form of machine learning. And when you are giving this information, the app is realizing that you are similar to a particular suggestion which were made for this 1 million investors. So a very similar pattern, for example, out of 1 million pattern, this artificial intelligence has been able to find out that the person C out of this 1 million investors has a profile like the profile you have made for you. In that case, the suggestion made by the robot or robo-advisor is based on this C, based on the suggestion made for the C. However, what is the limitation? If it is like that, you are a particular individual like Elon Musk. You heard about Elon Musk?
Yes, sir.
Yes, sir.
Okay. Who is very different from the traditional people, right?
Yes, sir.
Whose thinking is very different from the traditional people thinking. If it is like that, Elon Musk has visited this app and has answered this question, and it is very likely that his answer will be very much different and 0.0001% similar to the patterns thought to the robo-advisor in the form of machine learning. In that case, the app will give you or give the Elon Musk this kind of message. Why? Because the pattern of this particular investor does not match the pattern available which are thought to robo-advisor. However, in 90% cases or 80% cases, it may work. Which will? Robo-advisor services will work. Okay? Clear?
Sir,
Yeah.
sir,
Yeah.
if an asset manager uses smart beta, then can we say that he falls in the middle between active management and passive management?
He may fall, but if he purely follows only a smart beta strategy, and he does not follow any other strategy, okay, in that case, you need to term that manager as a passive manager, okay, because it is more similar to you are not making any analysis, you are not making any analysis, you are just focusing on it. Okay. Let's move on. And if you try to understand from the perspective of investor right now, not portfolio manager perspective, that what are the investment products available to you? So one common product is mutual fund. And I think you probably learned it very well from your FMI course. And I will try to give very high-level remark on this investment product. And mutual fund is a kind of investment vehicle which pulls investment from small investors and make investment according to their fund strategy. Okay, so with a very small denomination, what can you do? You can participate in the mutual fund. And what is the advantage? Advantage is that instead of having a big, if you don't have large sum of money, or if you don't have good knowledge of investment, you can rely on the professional fund manager. That is the advantage. So as an investor, we learned about the investor in previous slide, and now you are an investor. You are looking for the products available in asset management industry, and you are trying to pick the product which is suitable for you. Okay. So mutual fund can be classified as no load and load, and I think you probably have heard about it, why some funds are load and some funds are not load fund. Have you heard about it, upfront and back end load? Anyone? No one?
Yes sir, but হচ্ছে যে একটু ভুলে গেছি স্যার এখন।
ভুলে গেছেন?
একটু মনে করে দিন।
Okay, fine. So when you are making investment, that means you are at the beginning, when you are purchasing. If it is like that, in addition to asset under management fee, asset management fee by the mutual fund managers, they are also charging a percentage from you to purchase the mutual fund share from them. In that case, you are paying upfront load. It is known as upfront load. If it is like that, you want to sell your investment and you want to get off from the mutual fund. If it is like that, funds are requiring you to pay back-end fee. That means you are retiring from the fund and you are obliged to pay back-end or redemption fee. In that case, this is known as back-end load. So some mutual fund charges this fee or only charges this, not this. Whatever, these funds will be known as load fund. In contrast, the funds which don't charge these funds, they are known as no load fund. Okay, and you are very familiar with the open-end fund and the closed-end fund. Okay.
Yes, sir.
Is it? Okay. So which fund has flexibility to increase their investment between open-end, closed-end?
Open-end funds.
Open-end fund, they are open to take new investment from their new investors. However, closed-end fund are not. Okay. So between open-end fund and closed-end fund, in which fund you can redeem your investment from the fund itself instead of going to, you don't need to go to market?
So open-end fund.
Open-end fund. Okay. Do you have any idea how many open-end fund right now are operating in Bangladesh? Are you seeing my browser?
Yes, sir. We can see that.
I am right now in BSEC website. And are you seeing from where I am visiting? You
Yes,
see
sir.
the address? Okay, issue of securities fund, mutual fund. So in this list, you will see there are 34 closed-end funds right now in our country and 58 open-end fund. Okay, open-end funds are not market traded. I mentioned about the race fund. Okay, and I mentioned about the Edge Bangladesh, and that is also open-end fund. And I also have, for example, investment in Longkabang Al Arafa Sharia Unit Fund. These funds are also open-end fund. And IDLC Growth Fund, these funds are open-end fund. And the funds which are very familiar to you, which are market traded, those funds are closed-end fund because they need to be listed in the market. And investors, if they try to redeem their investment, what they need to do, they need to sell their share to the market, to the investors who want to buy the mutual fund share which you want to sell. If you see that there are less number of investors who want to buy the mutual fund share you want to buy, which mutual fund? Closed-end fund. Okay. In that case, what will happen? If the number of investors or the investors' interest is less, the price of mutual fund will go down, or it may be traded at a discount. Discount from what?
Face value.
Discount from NAV. Okay, I think you are familiar with the NAV, or net asset value. Okay, so based on the asset class focus, it can be bond mutual fund, it can be equity mutual fund, or it can be blend of two. Okay, and investment strategy based on that mutual fund can be further classified. For example, if it is like that, they focus on growth strategy, you will probably see the growth in their title, that growth fund. And if their strategy is particular value focused, you are likely to see the value title in their fund name. And in case of bond mutual fund, if it is like that, their title is saying that their investment objective is to invest in high yield fund, you will see this high yield word in their title. And also you will see the investment grade. Okay, that means high grade, or a grade above B. Okay, so you will see this kind of particular focus. These are some kind of investment objective and investment strategies. Okay, separately mentioned account. One particular disadvantage of the mutual fund is that you don't have choice in investment. You may have a broader choice, but you may not pick the specific choice. Okay, for example, you are a Sharia compliant investor. Sharia compliant investor, plus you are an ESG investor. Have you heard about this term, ESG? Environment, society, governance. You want to focus on this. You don't like to invest on those stocks of which the company pollutes environment, or not congenial to the society people, or their governance are poor. You don't like these companies. Okay, for example, you can think of, you want to exclude this company because their business is detrimental to the environment. Am I clear?
Yes, sir.
Why you are excluding this? You don't want to include this because they are not Sharia compliant business, because they want people to consume tobacco. Okay, so in that case your portfolio should not include this. Am I clear? In that case, what can you do? You can't go to a mutual fund because you may not find a mutual fund which meet your particular needs. What can you do? You can go to asset management company, and you may say that I have, for example, I have 10 million money and 10 million fund, and I want to invest following this. Okay, following this. So asset manager will take your fund, and they have the discussion, and they will try to follow your objective. They will try to follow your particular statement, and they will manage a portfolio on behalf of you. But what is the disadvantage? The disadvantage is that to subscribe to this particular special product, you need to have a high worth, which may not be feasible for the small investors like me. Is it? Are you getting?
স্যার
Yes,
অ্যাকচুয়ালি
sir.
আপনার কথা আবার স্যার ইন্টারাপ্টেড হচ্ছে, সো স্যার কথা ট্র্যাক রাখা যাচ্ছে না যে কোনটার সাথে কোনটা রিলেটেড।
Okay. I have used all of my available resources. So if still disruption continues, you may look at the recording after having the class finished. Okay. Exchange traded fund. Yeah.
স্যার এই কানেকশনটা স্যার এর আগেরটা থেকে বেটার।
Okay, fine. I'm using now mobile data. Okay, exchange traded fund. Matter is that this
Sir.
is yeah.
So what it mean by high worth of an individual?
A high worth means you are a rich person.
If
Yeah. Okay.
Okay, sir.
Exchange traded fund accommodates the advantage of the open-end fund and the closed-end fund. Okay. And tries to reduce the disadvantage of this fund. So how these are similar? Exchange traded fund is similar to open-end fund in a way that it can increase the investment by issuing more share. It is similar to closed-end fund in a way it is market traded. It is market traded on a real-time basis like other market instrument like a stock, bond. So in mutual fund, it is a closed-end fund in particular, you can buy this at a particular time on a day, or in case of open-end fund, you can buy or sell this based on the NAP in a particular week. However, in case of exchange traded fund, you can trade it instantly based on the real-time market price. Okay, so there are some other specification. You'll try to go through it, and the hedge fund and how these hedge funds are separated because they are less regulated compared to the mutual fund. They are less regulated. They are high risky. They are for highly rich individual or high worth individual, and they adopt a diverse strategy. Diverse, it can be a long short strategy. I already have given you an example: long the small size stock, short the short the big size stock, and they are permitted to use a good amount of leverage, which may not be which is not available in case of mutual fund. So the hedge fund and other restriction, liquidity restriction, that it's like that if you're a hedge fund investor, you are not able to withdraw your fund before 5 years, as a kind of example. Okay, so this kind of restrictions are there in hedge fund. Okay, in case of private equity fund, the fund, if you are an investor in private equity fund, it means that the fund is not investing in the companies which are publicly listed. Rather, they are focusing on the companies which are privately held. For example, they are investing in Pathau, or they are investing in, for example, they are investing in Boshundara, because the Boshundara Properties, for example, which is not publicly listed. So they are privately held. So private equity funds tries to invest in this kind of companies which are not publicly listed, and they engage in high risk investment compared to mutual fund and compared to However, their risk exposure is less than the venture capital fund. And one similarities with the hedge fund and the private equity fund is that if you want to invest in private equity fund, you need to have a high worth. With a small investment, you may not get subscription to the private equity fund. And in venture capital fund, you probably have heard about the trend of startup companies. And startup companies get the fund from which kind of fund? Venture capital fund. So as an investor,
SoftBank is a venture capital fund.
Sorry?
So SoftBank, is it a venture capital fund?
Soft fund, is it
SoftBank.
SoftBank? Is it global or Bangladesh? I have not
Global.
heard about it. Global?
Yes, sir. So they are very popular. So they have
Okay.
invested in Uber and other.
Okay, yeah. It can be, in that case, it can be venture capital fund. Okay. But the thing is that, do you know that we have some private equity funds and venture capital fund in our country? You see the list. Alternative Investment Fund of Bangladesh and IDLC Venture Capital Fund, these are venture capital. And Lanka Bangla First PE Fund, these are private equity fund, okay? And you may ask that whether we have any exchange traded fund. The answer is no. Right now we don't have exchange traded fund. However, the regulator and the asset management companies are trying their best to introduce the exchange traded fund in our market very shortly. Okay, so we'll try to conclude our this lecture by telling some high-level points on our asset management industry in Bangladesh. Our market size is very narrow, only 0.12 trillion. Okay, so I have shown you the list of mutual fund, open-end, and closed-end funds. These funds are operated by the asset management companies. But you may ask how many asset management companies right now are operating in Bangladesh. The number is 47, which is very narrow or which is very low. And we have both pure play and diversified firms. I already have given you some examples how they are different and who are they in Bangladesh. And in case of Bangladesh, mutual funds are actively managed because we don't have a particular reliable index to follow. And so they are mostly actively managed, okay? And I already have given these statistics, and this percentage, 0.12 trillion of the asset, not this amount. If you look at the market capitalization of mutual fund in Bangladesh, this is only 1%. It is less than 1%. I have rounded this number to 1%. Okay, and our asset classes are limited. Why? Because roughly all of the mutual funds are equity mutual funds are, or the mutual funds in general in our country are obliged to make their 60% investment in equity and 40% in other asset classes. So if the equity market in aggregate goes down, what do you expect? What will happen to the mutual fund industry?
So mutual funds value or price will go
Are
down.
expected to underperform because their lion share is on equity, and they have limited scope to diversify their portfolio. So regulator is trying to increase the number of asset classes available in which the fund or the investors can invest more of their investment and make their investment diversified. Okay. So we'll try to begin our second lecture. with some microeconomics concept. The thing is that if you are a portfolio manager, you need to understand that how your client can be an individual, your client can be an institution. You can think of an institution is a collection of individual, right? So ultimately, individual behavior may influence the institutional behavior. Okay, so most of the time, when you will work as a portfolio manager, you have to deal with the individual client. You have to deal with the institutional client. What are the institutional clients? I have made in lecture 1 examples: bank, financial institutions, defined benefit pension plan, insurance companies, you see, then endowment fund, then foundation. These are your institutional and investor. In higher level education, you will see that specific chapter is devoted how you manage the portfolio of this particular investor, this particular individual investor. Okay, so right now we have approximately 100 participants, and you know very well, if I give you to make one decision, and 100 individuals of you will make the decision in 100 ways, because individuals are different. Individuals are themselves different. So it is not very likely that you can make a standard framework to discuss the individual decision in a way. Okay. So what can you do? You can standardize. Some rational thinking or rational decision making of individual. If you don't understand how individual need to make rational decision and how they actually make decision, you can't compare why they are irrational. So what you need to understand? You need to understand what should be the standard or what should be the rational decision making. So if you're an individual, you have income over the time. You have income in year 1, year 2, year 3, year 4, year 5, this way. Okay. So out of the income, any individual decides to consume all of his income or allocate his income to some big component you learn from your microeconomics. One is consumption, another one is consumption. What is remaining after consumption, that is for
Savings.
Okay, so that is the typical way how we try to allocate our income. Okay, but how people make decision, we'll try to summarize the understanding from the microeconomics, because otherwise you unless you understand the individual behavior, you may end up giving or suggesting some products, some standardized product to an investor who does not actually want that product. Okay. For example, think of a retail cloth shop. I think all of you have visited their retail cloth shop or retail cloth store.
Yes.
Okay. If you try to take one dress, you try to take 10 dresses and wear these dresses one by one, and wants to know the feedback from your friend or from the shopkeeper himself or from the salesman, that how you look like in this dress. Is it a typical question?
Yes, sir.
Okay. It is very likely that you will see that salesman is telling you that out of the 10 dresses, if you come up that, if you conclude his comments, you will see that out of the 10 dresses, in 90% cases, salesmen told you that this dress is perfect and super perfect for you. And you look very beautiful, or you look very handsome by wearing this dress, is it?
Yes, sir.
But you know very well that out of these 10 dresses, it is very likely that only one dress is suitable for you. I'm ignoring your budget. I'm not considering your budget. I'm just considering your preferences. Your preference, you have preferred only one dress. But salesman is telling you in such a way that out of the 10 product, or out of the 10 dresses, 9 dresses are super perfect for you. He's trying to generalize, or he does not want to know your preference, or he does not study your preferences very well. Are you getting?
Yes, sir.
So now put yourself in the shoe of shopkeeper. You are a portfolio manager. If you don't understand your client well, you may end up suggesting or giving a product to your investor, a certain investment product to your investor, which is not suitable for him, which is not suitable for him. Okay. So have you understood why we are going to understand the behavior of individual and how they typically make decision? Okay. So it is not only about understanding mean variance of the stock, and you have got that particular stock A has, for example, I have the new stock. You probably have heard about this company. This is the Chinese Tesla. So this company in last 7 months has given me 950% return. Okay. So if I'm super excited, regardless of your preferences, I am very likely to suggest you to buy the new stock, right? If I don't understand your preferences, because you will see that their monthly mean return in last year is close to 250%. Just an example. So it's not all about mean and variance and the correlation and the portfolio construction in that way. You need to understand the how people make decision. Okay. So we are trying to think of a model, a very simple model. We are trying to think of two periods. One is current period, another one is future period. You can think of T0 and T1. So if you don't like this model, what can you do? You can think of this current period as of today, and all future point of time from today to till 50 years or coming 60 years in the future period. So if you can understand this, you can make decision for all available period. Okay. So we tries to begin with a simple model. So you have a current period of income Y0 and next period income Y1. Okay. So these are some typical assumptions you make in your microeconomics model, and finance is all about discussing models, because the theories are displayed, or theories are portrayed in mathematical model. So you can look at the theory from the model perspective. Okay. So are you familiar with this kind of diagram? What I'm showing here, in vertical axis, I'm representing an individual current income and consumption, and in horizontal axis, and in vertical axis, I'm representing future income and future consumption. Is it?
Yes, sir.
Okay. So what can you do if I think of an individual like you, because you are going to be graduated very shortly and you will have a good job in next year. However, uh, your income is right now, current income is expected to be high compared to the income available after your retirement. Okay, that's why current income is a bigger number. You see, current income is a bigger number, future income is a smaller number. Okay, so it is the typical scenario of a person who is a young person. Okay, his current income is high and future
Sir.
in, yeah.
Sir, shouldn't this be the case of aged person? Because the current income is higher than future income. In future, an aged person will retire and their income source will be
Okay, but I'm thinking of a person.
they have income.
Yeah, I'm thinking of a person. This is a young person, but it's not a very beginning. It's not a very beginning. It's kind of uh, you can think of a very smart executive who is also or 50, 60. Okay. What I'm trying to focus, it is not the focus of age. The focus is how you allocate your income or consumption. If it is like that, what is the typical scenario? Before your retirement, your income is very high, which is the current. However, after your retirement, your income is low. After your retirement, your income is low. So when your current period of income is low, income is high, and if there is no other option, like if there is no financial market by which you can deposit some of your income to financial asset, what you need to do? You need to consume all of your income. You need to consume all of your income. Okay. So here, age is not our focus. Our focus is that when a person is before the retirement, before and after retirement. It is the before retirement scenario and it is the after retirement scenario. Okay. So in that case, after retirement, you will have a low income. However, before retirement, you will have a high income. Okay.
Yes, sir. So the allocation of consumption and saving in high income scenario, saving will be lower. So is it the point?
For high income individual, the savings will differ based on the age, based on the interest rate, based on the savings opportunity. Okay, we'll talk about it later. So what we are trying to see that if it is like that, there is no financial market. There is no financial market. What will be the scenario? The amount of income what you are earning, you need to consume all of your income because there is no opportunity to defer some of your income. There is no opportunity to keep some of your income in deposit account. And in future, if you have this amount of income, you need to consume this. So this is more similar to Lucas fruit tree economy. You may have found this example in the microeconomics text, that in every year, your apple tree will give you some apple. Okay, so there was no freezer invented. So, and there is no market in which you can sell your apple. So in that case, what you need to do, you need to consume all of your apple in each period so that no apple will get rotten. If you don't consume, your apple will get rotten. Okay. However, if there is a presence of financial market, what can you do? Here, it was our beginning point, right? You are now, out of your total income, you are consuming this amount of income, and you are depositing this amount of income into a savings account. And in future period, what you are doing, you are collecting the deposit original amount. Which amount? This amount. Okay, this amount. And what you are doing, and you are also getting some interest in future period. Okay, so the person who is saving, he is able to get more consumption in future period when there is a financial market. Okay. However, if there was no financial market, it was not possible. He need to stay here. The amount of income, the amount of income, and the amount of consumption in each period would be same. Okay. But the thing is that it depends that whether you want to save or you don't like to save. There are some factors. We'll try to discuss that. So if I try to express this concept in notation, okay, this is our current income. Why not? Are you understanding what I mentioned here?
Yes, sir.
This is our current income. This is our future income. So when you are depositing some of your income, let's assume that deposit is expressed by the delta. In that case, what is your consumption? Is it your current period consumption is equal to current period income minus delta? And what is your future period consumption? Your future period consumption is your future period income plus you have made some deposit in previous period which you want to receive now. That is this delta, the deposit what you made in previous period multiplied by 1 plus interest rate what you have generated in this period, right?
Yes, sir.
So can we write in this way? So in current period, your consumption now is less than your current period income. Why? Because you have made some of your income and you have transferred some of your income into deposit account. And in future period, your consumption is greater than your future period of income. Why it has become possible? Because your future period of income has become, your future period of consumption has become bigger for the amount of savings you made in previous period and the amount of interest you have earned on that deposit. That's why the consumption you are making in this future period is greater than the income you are getting in future period. So how it has become possible?
Yes, sir.
Because of the presence of financial
So because
market.
of the financial market.
So otherwise it would not be possible. So if it is like that, you are an impatient investor. I have mentioned a word, impatient. Impatient. You don't like to wait. You don't like to wait for future. You like present more. You don't have much faith on future. You'd like to enjoy yourself in present. Okay. However, our parents think more about future. Typically, they don't like to enjoy their present. Is it the typical scenario?
Yes, sir.
Who are more impatient? Young people are very likely to be impatient, and parents are more likely to be patient. So if you look at the loan profile of the aged people, or the age distribution of the people who are the borrowers, you will see that young people takes most of the loan. Young people take most of the loan, and aged people borrow less. Why aged people borrow less? But okay, answer me, why young people borrow more? Why
Because
young
money,
people
but they
borrow
want to
more?
take loan
Because
and they want to purchase now.
usually young people have this pattern. Their current consumption is less than their current income. Is it?
Yes, sir.
So that is the core reason why young people wants to borrow more. Is there anyone between among you who is very patient, that you think future are more valuable than present? You don't like to enjoy in current period?
So sometimes yes, sometimes no.
Sometimes yes, sometimes no.
It depends on the utility that I will derive.
Okay, so what I was mentioning, that if you are an impatient, what you will do?
So I will borrow more.
You will borrow. So earlier the point was here. Right now what you are doing? You are borrowing in top of your income, current income, to increase the consumption from this point to this point. So in that case, what will happen? You need to repay your loan in future. If you
Yes, sir.
You are borrowing something from bank or some financial institution, based on what? Based on that you will be able to repay your loan from your future income. You are currently borrowing based on what? Based on the belief that you will have future income in future periods, so that you can repay your loan very well. Yeah.
Yes, sir.
So this is an example for what kind of investor? Impatient investor.
Patient investor.
And this is an example of patient investor, right? So if you don't understand how your investor patience level, will you be able to give a particular product which is suitable for him?
No, sir.
If the person is, for example, impatient, your investor is impatient, can that impatient investor purchase the hedge fund?
No, sir.
Thank you. So if I assume that the delta indicates both savings and the borrowings. If delta is savings for borrowing, what will happen to delta? It will become negative delta. Is not borrowing equals to negative savings? Is borrowing equal
Yes,
to
sir.
negative savings? Okay. So in that case, for impatient investor, what will happen? For impatient investor, delta will be less than 0. Okay. So what impatient investor is doing? Impatient investor is consuming more than his current income because he is borrowing, and impatient investor will have their consumption less than the income available in future. Why? Because he is bound to make repayment of the loan. So this amount of repayment will reduce, will be subtracted from his future income, which will make the C1, that means consumption, less than what? His future period of income. Okay. So the time is already over, as we have our holiday in next week. So can I take 10 minutes extra from you so that I can finish at 1:15?
Yes.
Yes, sir.
Okay. So this is an example of consumption opportunity set. Based on the patience and impatience, you can prefer whether you will stay here or you will stay here or you will stay here. How you will decide? It is it is combining all of the consumption pattern. What can you do? You can do by making trade-off between current consumption and the future consumption. You can pick any one. So if it is like that, you are a patient investor, right? Or you are an impatient.
Sir, impatient.
You are an impatient. What you will try to do? You will try to consume more now, consume less tomorrow, and you want to borrow. However, if you are patient, you will try to stay here. You want to consume less today, you want to consume future, you want to consume more in future. Okay. So what is the maximum current period consumption you can make? Just try to understand. It is your current period of income. What can you include in your current period make consumption? But you can also borrow. So the lender will think of your future income. Lender will give you the amount of loan which is the present value of your future income at maximum. Is it? It is your future income. I'm summarizing all of your future income in aggregate. So I'm discounting this future income of you and by 1 plus R or risk-free rate. And this is, can it be your maximum borrowing?
No, sir.
Why?
In future period, we won't consume anything.
Yeah, it is unrealistic, but what regardless of that I don't have consumption, C1 is equal will become 0. But how much amount of borrowing you can make today? Is it the maximum? Or you can borrow more than this?
So this is the maximum.
This is the maximum, because if you borrow more than this, you will not have the capacity. So lender will understand what will be your capacity. Your capacity will be maximum this amount. So what will be your maximum consumption? Your current period income plus the maximum consumption you can borrow. maximum amount of borrowing you can make based on your future income. Okay, so if it is true, if it actually happens, what will happen? It will become 0. And in contrast, if it is like that, you are saving almost all of your income, all of your current income. That means your current income is YO or Y not. You are saving all of your Y not. That means your savings delta becomes Y not. In that case, what will happen? You are getting interest on all of your present income. That means you have saved all of your money, what you have earned in current period, and you are consuming all of this after getting with interest in addition to your future income. And this is the maximum amount of consumption you can make in future. If it is true, you can't consume anything today, is it?
Yes, sir.
So these are the extreme cases. It cannot happen. It cannot happen. So what people usually do, people don't stay here. People don't stay here. Rather, people stay any point on this line from this one to this one. Okay. So why you are saving? Because you want to increase your future consumption. Why you are borrowing? Why you are borrowing? Because you want to increase your
Current
consumption. So you are a student. So which one is more? Which one is perfect example for you? This one is perfect example for you, because students in developed countries are typically loaded with the student loan. Based on what? How they are given loan. They are given loan by the lenders based on their potential income in their career. Okay. So if you want to gain, if you spend 1 unit of, or if you deposit 1 unit of income from 1 unit of amount from your current income, how much you will get in future? 1 into 1 plus R. Okay. So these are some extreme case scenario. If I ask you, where do you want to be, or where do we want to be? Here, here, or here? Which one? Bottom, top, left,
The middle.
right, middle? Okay. So who have mentioned middle? Your name, please.
Zain.
Sorry?
Sir, Zain.
Jaid. Okay. Jaid is wanting to make consumption smoothing. Why? Because he is trying to pick a consumption point in a way so that his current consumption and future consumption don't deviate much, because his current consumption is, you say roughly his current consumption is 120, his future consumption is roughly 120. In that case, he is more happy to allocate his income in such a way so that his consumption will be roughly equal in 2 periods. Am I clear? Have you got the concept of consumption smoothing?
Yes, sir.
So if the person does not want to do this, the person is, for example, wants to stay here. That person clearly does not want to make the consumption smoothing. Rather, that person is impatient or patient.
Impatient.
That person is impatient because he wants to borrow more. He wants to borrow more on top of his current income. And if the person is here, and if you pick in here, you are more patient because you want to save more by reducing your current consumption. Okay. So actually, the Jait mentioned this point because he thinks that his utility will be maximum here. And if I think that my consumption set should be here, I'm thinking my utility should be maximum here. If it is like that, another person is thinking here, he thinks that his utility will be maximum here. Okay. So the whatever your consumption point, what you want to do, you want to maximize your happiness. You want to maximize your happiness. And right now we have 50 participants. So 50 participants have different choices of current consumption and the future consumption. And 50 participants have different utility function. 50 participants have different utility function. One participant can get more utility from current consumption, less utility from future consumption. If it is like that, that person is patient or impatient. You want me repeat?
Yes, sir.
If the person gets more utility from current consumption and less utility from future consumption, that person is impatient. That person is impatient. And in contrast, the person can be patient. Okay. So what you have learned about the utility in your microeconomics, that more is always better. More is always better. What we have done, we have included both current period consumption and the future period consumption and include both in single utility function. You don't want to be interested in a utility function of a particular period of time. Rather, you want to maximize your utility in both 0 and 1. So the more is always better. Is the first derivative of this function. First derivative of this function. What does it mean? It means that you are already, you can never satisfied. You can never satisfied. Is it a typical example?
Yes, sir.
That you are never satisfied?
Yes, sir. Demand is unlimited.
Demand is unlimited, but satisfaction matters. It is not a typical case. For example, our parents, if we give one dress on festival, he is quite satisfied. But if we ask about our sister, instead of having 10 dresses, he is not satisfied. Sorry, she is not satisfied. Is it a typical?
Yes, sir.
We want more. We want more. So we never get satisfied. We want, that means economics is always greedy. Because economics tells you all of the option by which you can increase your happiness and satisfaction. It's all about increasing your own individual happiness, not other happiness. Where your happiness is greater, go after that. Where your happiness of people is greater, economics does not tell you to go there. Economics always tell you to go after your own happiness. So economics is always telling you to become greedy. That's why the utility function The first derivative of utility function is that you should never be satisfied. You should never be satisfied. The more you get, the more happier, the more richer, the more happiness you get. However, if it is like that, it is in terms of total. It is in terms of total. Okay, if your total goes up, your happiness goes up. That's why you see that your utility function in this way. Have you seen this kind of diagram in macroeconomics?
Yes, sir. Indifference curve.
Is it indifference curve?
No, sir. No, sir. This is not indifference curve.
This is not indifference curve. Okay. So another thing is that decreasing marginal utility. Though your total happiness will go up, however, when you are richer, for example, your refrigerator, in your refrigerator, you have 5 kilo of chocolate. In your refrigerator, you have 5 kilo of chocolate. So if I visit your home and I give you 2 kg, not 2 kg, 200 grams. If I give you a packet of 200 grams chocolate, will you be more happier compared to a poor person who does not have any chocolate in his home, and I bring this amount of chocolate
No,
to
sir.
this poor person? Which person will be more happier?
So the poor person.
The poor person will be more happier because his level of richness is low. And when you are more richer, the extra unit of consumption will give you less happiness compared to the poor person who does not have that amount of wealth you are possessing. So how can we measure the marginal utility? This is the second derivative you learn from your mathematics course. Okay, this is the second derivative. You get the marginal utility by making second derivative of this utility function. Okay, so you learned about, have you ever seen this diagram? This surface, this mat?
No, sir.
Okay.
No, sir.
So you probably have seen this kind of diagram, utility of a particular period. Okay, utility is going up. However, it is going up, it is a concave shape, but because you are getting more happiness initially by consuming this amount. However, when you have consuming the same amount here, you are getting less happiness. That's why it is decreasing marginal utility. Is it?
Yes, sir.
That's why it
Increasing
is
at a
decreasing.
decreasing rate.
Yeah, decreasing marginal utility. Okay, so this is actually a 3D diagram which is connecting the utility of the current period and the future period. In this axis, we are representing consumption from current period, and in this axis, we are representing consumption from future period. Okay, so the level of this surface or the level of this mat, beautiful mat, indicates the index of happiness. If you, for example, if you are here, let's assume that the point is here. How much is your current consumption? It's approximately 120. And what is your future consumption? Your future consumption is approximately 65 or 70. So if we think in this way, okay, and if we think that it crosses in this point, so it indicates this level of happiness. It indicates the level of happiness. Okay, so compared to this point, compared to this level is in upper level. Compared to this level is in upper level. Or if you think of this, there is a line here. here in the background, which is not visible fully. Here is a line you can think of here. Okay. So if the mat is in a lower level, that means, for example, here, okay, or here, how much your current consumption? Only 25 or approximately 50 or 40 in future. So will your happiness be higher here or your happiness be higher here?
So in the right
On the right, your happiness will be higher
hand.
here. Okay. So the level of this mat is actually representing your level of happiness. The higher the level, the higher your level of happiness. So how this diagram has been drawn? This diagram has been drawn in such a way that it is actually representing your diminishing marginal utility. See this current consumption utility. You see my pointing, my annotation, you see?
Yes, sir.
It is for the current period consumption utility. You see? It is increasing. It is increasing at an increasing rate or decreasing rate.
So decreasing rate.
It is increasing at a decreasing rate. And conversely, in future period, it is also increasing, but increasing at a decreasing rate. Okay. So if I connect this, if I connect the utility from here and connect the utility from here, what can I do? I can draw some indifference curve. I can draw some indifference curve. Actually, the indifference curve are not on the mat. Actually, indifference curve are on the surface, are on the level. Okay. Just think of, if you find it difficult, this is not that difficult if you understand. Try to understand this surface. This surface is the same surface what you have seen here. This surface. Okay. So indifference curve is actually on where? Indifference curve is actually here. Okay. So you are getting reflection here. You are getting reflection on the mat. Okay. It is not actually lying here. It is actually lying where? It is actually lying on the mat, which indicates the which indicates the level of satisfaction, and each of this contour, each of this point, each of the point indicates what? The same level of satisfaction at each point, though the combination of the consumption of current period and the present period are different. Okay, so what I already have shown you, just make it clear that this is actually indicates what? Decreasing marginal utility. Okay, so I already have shown you the indifference curve is actually here, and you are getting the reflection here. Okay, so the higher or the lighter region you are getting, the higher happiness or lower happiness?
So higher happiness.
Higher happiness. Okay, but you can't forget your consumption bundle available, right? You need to think of the consumption bundle, what you can afford based on your income and the based on your income and the future, based on your current income and the future. Okay, so we already have mentioned that what impatient investor will do. Impatient investor will consume more than future, will consume more in current time and consume less in future, and the patient investor will do just the opposite. If I ask you now from a simple diagram in this way, okay. If it is, for example, consumption bundle, if I draw indifference curve in this way, Sorry. Is it for the passion investor or the impassioned investor?
Patient investor.
Why?
So because indifference curve touches on the left point where future consumption is higher.
Okay, but from the indifference curve, other than touch of the indifference curve or the tangency of the indifference curve, you need to understand in this way that you need to look at the slope of the indifference curve. Okay, look at here. For sacrificing this unit of consumption, how much this investor is expecting in future? This amount, which are roughly equal or slightly greater, okay? The slope is less than 0 or greater than 0. If you are a passion investor, you discount this future consumption with a positive number or a negative number, or with a low number. If it is the discount factor and it is your utility of future consumption, you will take a discount factor. It is actually total discount factor. As you are a passion investor, you will discount less. You will discount less because you don't prefer current consumption. But if it is such that I'm removing it. If it is such that now look at here. It is an example of impatient investor. How you see, for sacrificing this amount of current consumption, he wants a bigger share of future consumption.
Yes, sir.
Just think of this way. Think it separately. For impatient investor and for passion investor, which one has higher slope between this A and this? Which one has higher slope? Which one has higher slope? For A or B?
So B has higher
B.
slope. B.
B has higher slope because B is impatient. Why we are saying B is impatient from this curve? Because for sacrificing this unit of consumption, as he is impatient, he wants a very high amount of compensation from the borrower. As he is impatient, otherwise you can't convince him not to consume not to save this. For impatient investors, he wants more of the future by sacrificing this. However, for patient investors who is not very sensitive to the future consumption, who is not very sensitive to the current consumption, but much sensitive to the future consumption, if he sacrifices this amount, what can you do? You can convince him with this amount. Why he is not expecting more? Because He himself is a patient investor. He himself is a patient investor. When investor is patient, what can you do? You can convince him to save money with a less amount of return, less amount of future return. But when investor is impatient, you can only convince him to save now by giving return but at a higher rate. Have you got it?
স্যার তাহলে ইমপেশেন্ট হলেই ভালো না স্যার?
Huh?
তাহলে
Yeah.
ইমপেশেন্ট হলেই ভালো না যে বেশি রিটার্ন পাবো?
So don't forget about the risk. Higher return comes with what? Higher return comes with higher risk. Okay. So just summarize this in the here. If we present this diagram, 3D diagram for an impatient investor, you see, for sacrificing this amount of current consumption, impatient investor is expecting this huge amount of consumption in future. So it will be very difficult to convince him unless you give this. Okay. So for impatient investor, the amount of compensation what you need to give as a lender, you need to give more. Okay. Or if you are a company, you are borrowing money. If you see most of the economic entities are impatient, they want more of current consumption. In that case, what will happen? It will go up. Will it go up? As most of the investors are impatient. But if it is like that, most of the investors are not impatient, rather they are patient. In that case, you can convince them with less amount of future consumption. That means you can convince them with a low interest rate. Have you got it? The difference between patient and impatient? Who needs higher compensation in future?